Entrepreneurship is an exciting journey filled with opportunities, innovation, and challenges. However, one of the most critical aspects that determine the success of a business is financial planning. Whether you're launching your first startup or scaling an established business, understanding and managing finances effectively can make all the difference between success and failure. The module Introduction to Financial Planning for Entrepreneurs in the course Financial Planning for Entrepreneurs, Build Your Dreams serves as the foundation for developing the skills necessary to navigate the complex financial aspects of entrepreneurship. What is financial planning? At its core, financial planning is the process of setting financial goals, creating a roadmap to achieve them, and managing resources to ensure those goals are met. For entrepreneurs, financial planning involves forecasting revenues, managing expenses, securing funding, and monitoring the overall financial health of the business. It provides a structured approach to decision-making, ensuring that resources are allocated efficiently and risks are minimized. Entrepreneurial ventures often operate in uncertain environments, where market dynamics, competition, and external factors can impact operations. A well-crafted financial plan helps entrepreneurs prepare for these uncertainties, make informed decisions, and maintain control over their business's financial direction. Why financial planning is crucial for entrepreneurs? Financial planning provides a clear picture of where your business stands and where it's headed. It ensures that entrepreneurs have a realistic understanding of their financial position, enabling them to focus on critical areas like growth, profitability, and sustainability. Entrepreneurs are often faced with decisions that have financial implications, such as hiring employees, investing in marketing, or purchasing equipment. Financial planning provides the data and insights needed to make informed choices. Businesses are exposed to various risks, including market fluctuations, economic downturns, and unexpected expenses. Financial planning helps entrepreneurs identify potential risks and develop contingency plans to mitigate them. Investors and lenders are more likely to support businesses with well-defined financial plans. A detailed financial roadmap demonstrates professionalism, builds trust, and increases the likelihood of securing funding. Growth without proper financial management can lead to cash flow issues and operational inefficiencies. Financial planning ensures that growth is sustainable and aligned with the business's long-term goals. Key components of financial planning. The first step in financial planning is defining clear, measurable, and achievable goals. These goals could include revenue targets, profit margins, or cost reduction objectives. For instance, an entrepreneur might set a goal to achieve a 20% increase in revenue within the first year of operations. Budgeting involves creating a plan for how the business will allocate its resources. It includes estimating income, identifying fixed and variable expenses, and setting aside funds for contingencies. A well-structured budget serves as a guide to ensure that resources are used effectively. Predicting future revenues is essential for planning and decision-making. Entrepreneurs use market research, historical data, and industry trends to estimate their income. Revenue forecasting helps identify potential gaps and opportunities for growth. Keeping expenses under control is critical to maintaining profitability. Entrepreneurs must track their spending, prioritize essential costs, and find ways to reduce unnecessary expenditures. Cash flow is the lifeblood of any business. Managing cash inflows and outflows ensures that the business has enough liquidity to meet its obligations. Entrepreneurs must monitor their cash flow regularly to avoid shortages and maintain financial stability. Financial planning involves identifying potential risks, such as market downturns, operational inefficiencies, or legal issues. Entrepreneurs can then develop strategies to mitigate these risks, such as diversifying revenue streams or maintaining emergency funds. Challenges entrepreneurs face in financial planning. New businesses often face fluctuations in income, making it difficult to predict future revenues accurately. Financial planning helps manage this uncertainty by providing tools to forecast and adjust budgets dynamically. Many entrepreneurs operate with limited financial resources, which can constrain their ability to invest in growth. Effective financial planning ensures that resources are allocated to areas with the highest impact. Not all entrepreneurs come from a financial background, and navigating complex financial concepts can be overwhelming. This course aims to bridge that gap by providing simple, actionable insights into financial planning. How this module helps entrepreneurs. This introductory module serves as the stepping stone for entrepreneurs to build a strong financial foundation. It provides a clear understanding of the basics of financial planning and equips learners with practical tools and techniques to manage their finances effectively. The key takeaways from this module include: 1. Gaining confidence in handling financial data and making data-driven decisions. 2. Understanding the importance of setting realistic financial goals and how to achieve them. 3. Learning the basics of budgeting, forecasting, and cash flow management. The module is designed to be interactive and practical, with real-world examples, case studies, and hands-on activities. Learners will have the opportunity to apply the concepts they learn to their own business scenarios, ensuring that they leave the course with actionable skills. Activities and assignments to reinforce the concepts taught in this module. Participants will engage in the following activities. 1. Self-assessment. Evaluate your current financial literacy and identify areas for improvement. 2. Budget creation exercise. Develop a simple budget for a hypothetical business scenario. 3. Goal-setting workshop. Define short-term and long-term financial goals for your business idea. These activities are designed to provide hands-on experience and prepare learners for the more advanced topics covered in later modules. Conclusion: financial planning is not just a technical skill, it is a critical mindset that every entrepreneur must cultivate. The Introduction to Financial Planning for Entrepreneurs module provides the foundational knowledge needed to navigate the financial aspects of entrepreneurship confidently. By mastering these basics, learners will be better equipped to set their ventures on a path to success, attract investors, and achieve their business goals. As you embark on this journey, remember that financial planning is an ongoing process. It requires regular review, adjustment, and a commitment to staying informed about your business's financial health. With the tools and insights gained from this course, you'll be ready to turn your entrepreneurial dream into a sustainable reality. Let's start building your financial success. 4. You said, write about key financial concepts: revenue, expenses, profit, and cash flow. In 700 words for this course, ChatGPT said, ChatGPT key financial concepts: revenue, expenses, profit, and cash flow. Entrepreneurs often dive into their business ventures with brilliant ideas, immense passion, and a drive to succeed. However, the backbone of any successful business lies in understanding and managing key financial concepts like revenue, expenses, profit, and cash flow. These terms are not just jargon, they are the lifeblood of a business that dictates its financial health, sustainability, and growth potential. In this module of Financial Planning for Entrepreneurs, Build Your Dream, we delve into these fundamental concepts to equip entrepreneurs with the knowledge they need to thrive. Revenue. The lifeline of your business. Revenue is the total income a business earns from selling its products or services. It is often referred to as the top line because it appears at the top of the income statement. Revenue is a critical indicator of how well a business is performing in terms of generating sales and attracting customers. Key points about revenue. 1. Sources of revenue. Businesses can generate revenue through various streams, such as product sales, subscription fees, consulting services, or advertisements. 1. Diversifying revenue streams is essential for minimizing risks. 2. Gross versus net revenue. Gross revenue refers to the total sales before deducting any costs or discounts, while net revenue accounts for returns, allowances, and discounts. 3. Importance of tracking revenue. Regularly monitoring revenue helps identify trends, seasonal patterns, and areas for improvement. Example: imagine a bakery that generates 100,000 rupees in monthly sales from cakes, bread, and cookies. This figure represents the bakery's gross revenue. However, after accounting for refunds or discounts, the net revenue might be 95,000 rupees. Expenses: the cost of doing business. Expenses are the costs incurred to operate a business. They are an inevitable part of running a business and must be carefully managed to ensure profitability. Expenses are categorized into two main types. 1. Fixed expenses. These remain constant regardless of production levels, such as rent, salaries, and insurance. 2. Variable expenses. These fluctuate based on production or sales, such as raw materials, packaging, and shipping costs. Key points about expenses. 1. Controlling expenses. Identifying areas where expenses can be reduced without compromising quality is vital. 2. Tracking expenses. Using financial tools to track expenses helps ensure accurate budgeting and financial reporting. 3. Unexpected costs. Setting aside funds for unforeseen expenses or emergencies is a good practice for financial stability. Example: a freelance graphic designer spends 15,000 rupees monthly on software subscriptions, fixed expense, and 10,000 rupees on printing and materials for client projects, variable expense. These combined costs represent the total monthly expenses. Profit. The measure of success. Profit is what remains after subtracting expenses from revenue. It is the ultimate goal of every business and indicates financial success. Profit can be divided into two main categories. 1. Gross profit, the revenue left after deducting the cost of goods sold, COGS, such as raw materials or manufacturing costs. 2. Net profit, the revenue remaining after all operating expenses, taxes, and interest are deducted. 2. This is also referred to as the bottom line. Key points about profit. 1. Profit margins. Calculating profit margins, gross and net, helps measure efficiency and profitability. 2. Reinvesting profits. Reinvesting profits into the business can fuel growth, such as expanding operations or launching new products. 3. Balancing growth and profit. In the early stages, entrepreneurs may prioritize growth over profit, but a balance is crucial for long-term sustainability. Example: a clothing store generates 200,000 rupees in monthly revenue. After deducting 120,000 rupees in expenses, including rent, staff salaries, and inventory costs, the net profit is 80,000 rupees. Cash flow. The pulse of your business. Cash flow refers to the movement of money into and out of a business. While profit shows overall financial performance, cash flow indicates the liquidity needed to sustain daily operations. Positive cash flow means more money is coming in than going out, while negative cash flow suggests the opposite. Key points about cash flow. 1. Types of cash flow. Operating cash flow, money generated from core business activities like sales. Investing cash flow, money spent on or earned from investments, equipment, or property. Financing cash flow, money obtained or repaid through loans, equity, or dividends. 2. Importance of cash flow management, ensures timely payment of bills, salaries, and other obligations. Prevents cash shortages that can disrupt operations. Supports business growth by maintaining liquidity for investments. 3. Cash flow versus profit. A business can be profitable but still face cash flow problems if its receivables are delayed or expenses outpace income. Example: a restaurant earns 300,000 rupees in revenue but has 280,000 rupees in monthly expenses. Although it has a 20,000 rupees net profit, delayed payments from catering orders create a cash flow deficit, causing operational difficulties. The interconnection between these concepts, revenue, expenses, profit, and cash flow, are interconnected. Revenue drives the business forward, but expenses must be managed effectively to ensure profitability. Profit reflects overall financial success, while cash flow ensures liquidity and operational stability. Entrepreneurs must strike a balance between these elements to build a sustainable and thriving business. Example: a tech startup secures 1 million rupees in annual revenue. With 600,000 rupees in expenses, its net profit is 400,000 rupees. However, if the startup faces delays in customer payments, it might experience negative cash flow, hindering its ability to pay vendors or invest in new projects. Tips for managing financial concepts. 1. Use financial tools. Leverage software like QuickBooks or Zoho Books to track revenue, expenses, and cash flow. 2. Set realistic goals. Create achievable revenue and profit targets based on market research. 3. Monitor regularly. Regularly review financial statements to identify trends and make data-driven decisions. 4. Seek professional help. Consult accountants or financial advisors to address complex financial issues. Understanding revenue, expenses, profit, and cash flow is essential for every entrepreneur. These financial concepts provide a clear picture of your business's health, guide decision-making, and ensure sustainability. Mastering these basics is the first step toward building a strong financial foundation and achieving entrepreneurial success. The Financial Planning for Entrepreneurs, Build Your Dream course is designed to simplify these concepts and provide actionable insights. With the right knowledge and tools, you'll be equipped to make informed decisions, manage resources efficiently, and turn your entrepreneurial vision into a reality. Start your financial planning journey today and pave the way for long-term success.